right now, Tesla is still number one, but they're going to have to find a higher gear to stay on top. The AI story is part of bringing costs down. The robo story is another part. And there's also Tesla's rapidly growing energy division. So these are all part of the picture that investors are going to have to keep an eye on. But get ready to see the big smackdown.
And who do you think is going to be the big winner in EVs? And is that going to then determine who's the big winner overall in sales this year?
Yes, I mean, overall, EVs are still a small part of the market, but at close to 10%, we think this year. We do believe, of course, Tesla will remain by far the market leader.
Do you know what Tesla's ultimate goal is? Well, it's to accelerate the world's transition towards sustainable energy. And while it may sound simple, it does hold a lot of meaning. Tesla plans to make EVs as affordable as they can be. And Steve Wesley, who happens to be a former Tesla board member, thinks that this is a very smart move and a strategic masterpiece.
For more on what is happening in the EV space, joining us now is Itai McKelly, Citi U.S. Autos and Auto Parts Analyst. Itai, it is good to see you. And I want to get to a note, Itai, you recently wrote here. You're now trimming your estimates for EV sales, both for this year and next, Itai. Itai, why did you make that call there? What are you seeing in the market?
Well, thank you for having me. Yeah, we did trim our estimates recently by a modest amount. We still see EV sales actually reaching about 9.5% penetration in 2024, and close to 15% by 2025. That said, given the slowdown and some of the revised plans by the automakers that we've seen announced, plus I would say a tough start to January, although December we think was actually a very good month. But just given the slower start in January, we did trim our numbers a little bit. I would say our views are probably still above the current consensus thinking, which has been very bearish on EVs the last few months. We don't completely agree with that. There are some adoption challenges out there that's reflected into our numbers, but we still think we'll have a pretty good year for EV growth this year on the back of some new product.
And who do you think is going to be the big winner in EVs? And is that going to then determine who's the big winner overall in sales this year?
Yes, I mean, overall, EVs are still a small part of the market, but at close to 10%, we think this year. We do believe, of course, Tesla will remain by far the market leader. Our forecast for market share this year is just under 50%. We think a new product, including the refresh on the Model 3, is going to be key for them this year. Of course, Cybertruck ramping as well. And then General Motors, as they ramp their Ultium platform, we think could be in about 11% market share. So sort of the first non-Tesla automaker with a double-digit market share this year as they ramp that platform. We think we need more product in the EV market. If you look at just some of the market coverage to date, it's pretty uneven in certain segments and certainly in certain price points. And one thing to keep in mind in the whole EV debate that's very important is in the U.S. we have on average about 2 vehicles per household. So the burden of EV adoption isn't about changing one's entire lifestyle to go all in on EV initially. It's really about converting households largely to one, combustion or ICE, and maybe a second one with EV. And if that starts to happen, you could see, in theory, a pretty rapid uptake of EV adoption over the next few years. But you need additional product. Of course, you do need better EV charging infrastructure, lower pricing, which IRA should help to some extent this year as well. So we think structurally the market is probably in better shape than what consensus currently.
For Tesla, affordability is a big priority. The automaker plans to lower the prices of its EVs so they become more affordable as gas-powered cars. This way, you won't be driving a Tesla while feeling like you just signed your life away to an electric overlord. Well, you get the point. Tesla's been throwing down with its recent price cuts, and it is just a sweet deal for eco-conscientious car lovers. But is there a bigger plan brewing under the hood? Well, today, we're going to be unveiling a huge secret, something that you might have been ignoring this whole time. This particular secret is the center for all that Tesla is doing, and if the automaker is successful in pulling it off, then it could change the EV game completely. So buckle up and let's dissect this strategy. And you can decide for yourself if it's sustainable or just a marketing ploy.
Tesla has plans to start production on a new mass-market EV dubbed Redwood, according to an exclusive from Reuters. Let's bring in Yahoo Finance's Pras Subramanian to get some more of the details on this. Pras, what do we know?
Yeah, so this is a big scoop here by Reuters on the day of earnings, right? This reporting of this mass production of this cheaper $25,000 EV, possibly their Gen 2 car that they'd mentioned in the past, at least a codenamed Project Redwood internally. Production, of course, potentially starting mid-2025, which is pretty aggressive. Kind of have to get that tooling in place for that a big rollout. And they want to do, I think, around, the sources told Reuters, around 10,000 units a week. So that's a pretty big mover, and it would start production potentially at Austin. Now, my understanding is that could this be a car that's also the robotaxi? Would it be a second car, two different cars? The sources told Reuters it could be two different or multiple cars with the platform. So we'll see where that goes. But I think the question is, can that timeline be reached? Right? Tesla's been known to basically overshoot their deadline. So Reuters sources told them 2026 is probably a more likely timeline for production to begin.
Yeah, because that would be a very, very close turnaround, right? We're talking about mid-2025. All right, Pras, let's talk about something that's going to be happening in just a few hours from now. You're going to be tracking the results that we're getting here from Tesla. Where does the street stand ahead of these results? And I guess, do you think we're going to see, in terms of what we hear from Tesla, maybe what we're getting here from Musk, just about the fact that do you expect, ease some of the concern that we have been talking about with lackluster EV demand? Yeah, and this is the big thing that people want to hear about. They want to hear about pricing versus product profitability, and then also what's going to be their new 2024 production target, right? So the street is looking for around 2.1 to 2.2 million vehicles a year for this year, which is only a 20% or so gain from last year, which is not that aggressive. But at the same token, can they actually improve?
On the surface, it's pretty clear. Cheaper Teslas mean more people can afford them, and more EVs on the road with less gas guzzlers spewing fumes out like a pretty crazy thing, which could be a win for Mother Nature. You see, Tesla's not shy about touting this mission. The automaker is all about accelerating the shift towards sustainable energy and making its cars more accessible for a big range of vehicles. And it's a step in the right direction. It's like a domino effect. One person goes electric, their friend sees it, likes it, and then before you know it, everyone's cruising around zero emission style. Hey guys, welcome back to Tesla Tomorrow. Tesla has been known for its premium price tag, which has kept the car company in an exclusive club. And now, with all the price cuts, the automaker is entering the realm of regular car buyers. It's a bold move, potentially shaking up the whole industry. Imagine the pressure on other car makers to step up their EV game. This competition that Tesla's created could lead to even more innovation, better batteries, and ultimately faster production and better cars. However, if Tesla wants to achieve this vision of actually becoming a big force to be reckoned with, and if they want it to become a reality, a number of things have got to be put in place, and without them, Tesla could just be starting a war that would finally consume it. So, what are these critical factors that should be considered? Keep watching to find out, but before we do, if you like this type of content, hit that like button, subscribe, and turn on post notifications to keep up to date on everything going on with Tesla. At Tesla's previous Investor Day, its CEO Elon Musk told shareholders that Tesla expects to cut manufacturing costs in half, particularly through an updated set of manufacturing processes, and through to its next-generation vehicle platform planned for production at its Gigafactory in Mexico. The scale of production is expected to help Tesla unlock vehicles with sub-$30,000 price tags, comparable to traditional gas-powered cars like the Toyota Corolla. Additionally, this is thought to help increase mainstream EV adoption as more and more consumers are able to afford the updated pricing models. According to Tesla's Vice President of Vehicle Engineering, Lars Moravy, higher volumes of auto production means lower manufacturing costs. The Tesla executive planned this while emphasizing how crucial manufacturing is, as well as a new generation EV platform that would be the company's ability to deliver long-term production targets. If Tesla is able to produce cars at a lower cost, imagine how many cars it's going to be able to produce and how much sales it could make. It would be groundbreaking.
You mentioned pricing. Is that, in your opinion, is that the biggest challenge for adoption right now? I ask because if you were in the market, you're looking for an EV, let's say around $35,000, Itai, there aren't that many options. Do you see that changing though?
It certainly is part of it, and in survey work that we've done, it does come up as one of the top 3 reasons and pain points of EV adoption today. But EV charging infrastructure, range anxiety, Even product availability also comes up in some of the survey work that we've seen. And what's interesting is some of the lowest priced EVs in the last couple of years have not been the most successful from a volume perspective. And one of the really impressive things that Tesla's accomplished amongst many in the last few years is, when you look at some of the third-party data around conquest, like who are they actually taking share from? There's a fair amount, more than I think people might commonly believe, of that conquest coming from mass market brands. As you actually see, and that's where the appeal of EVs, right? With successful EVs have done some pretty incredible things in terms of market expansion and conquesting from segments that are even lower price. But broadly, to your point, yes, price has to come down over time to increase adoption. Though we think 9.5% this year can still be done with some modest degree of a price premium relative to the overall market.
Itai, I guess I would ask my earlier question a little bit differently in terms of the number of vehicles versus the number of vehicles. If I am an investor and I am betting on the long-term viability and growth and eventually maybe dominance of EVs, is Tesla the way to go, or do I actually want to bet on one of the more traditional automakers who maybe have more room to expand there?
Yeah, everything is individual kind of risk reward. Right now with Tesla, we are on the sidelines with a 224 target, looking for more convincing entry points there, just on valuation. I think you want to look for opportunities where EVs can be very additive and accretive to market share and, of course, longer-term profitability by much more than what consensus bakes in. In GM's case, for example, right, and even Ford's, where you have substantial losses, we believe, running through the P&L today. If you can protect key parts of the combustion business, for example, pickup trucks, which we think will see slower EV uptake, then the EV uptake more broadly could end up being actually accretive to the overall earnings over the next couple of years if these companies can execute. And those could be really interesting risk-reward opportunities because you can see some real healthy degree of potential upward earnings revisions as those things play out. So we look for a combination of defensive qualities in companies and, of course, offensive qualities with EV, where you can have a real path to earnings upside and accretion. Of course, Tesla is still by far the market leader. Again, we think about 50% market.
For Tesla to efficiently lower its overall cost of producing cars, then its cost of raw materials should significantly lower too. And luckily, this is starting to unfold. Recent claims have also shown that lithium prices are starting to plummet due to an oversupply of this raw material in the market. And it might interest you to know that lithium production is one of the primary concerns for car makers worldwide, and they're scrambling to meet up with the anticipated demand, and long-term contracts and the purchase of mining companies are all put into place to ensure its supply. Therefore, since Tesla's already got a lot of competition, it will need to scoop up most of the world's supply of raw materials. Although battery tech that uses fewer materials to produce the same energies are still under development, they will not be mainstream by 2030. But you may ask, will there be a market for these cars that Tesla wants to manufacture in massive numbers? Well, very likely. Experts predict that EVs could match gas cars on price this year, more quickly than it seemed possible a few months ago. Sticker prices for electric vehicles are falling closer to the point where they could soon be on par with gasoline-powered vehicles. Similarly, increased competition, government incentives, and falling prices for lithium and other battery materials are all making electric vehicles noticeably more affordable. Judging by the current state of the market, it is fair to say that the tipping point when EVs become cheaper or just as cheap as ICEs could actually be sooner rather than later.
Well, lithium prices spiked back in 2021 before crashing back to earth at the end of last year. But it could just be the beginning of the fallout. Let's bring in Yahoo Finance's Inez Ferre, who's been tracking prices for us. Inez, how much of this is really tied to the EV demand? Obviously, lithium being a key ingredient there.
Yeah, that's right. Oh, well, a lot of this is tied to the slowing EV demand. And we did see prices really crashing over this past year, as you had mentioned. And we have a chart to show you just how much they have fallen. But look, it's no question that there's an oversupply right now in the market of lithium. China dominates this market. You do have US players in the market as well, and you've got companies in North America that have been really expanding their plans to mine lithium, to extract lithium, to refine it. Albemarle posted its results this week, and analysts were glad that the company is going to be spending less now that the prices are down for lithium, because it really doesn't make sense to go through with so many projects, scaling projects, if you are seeing the prices of lithium so low. That adage in the industry that the cure to low prices are low prices. Albemarle saying that it is going to be scaling back a project in South Carolina. It also had announced some layoffs at the end of January. Piedmont Lithium is another company that also announced layoffs. We interviewed their CEO earlier this week about the lithium market, and he says we're clearly in a bear market. What does this mean? It means that projects are being delayed. It means that some projects are being sidelined. And look, there's no question that the longer that interest rates stay at an elevated rate, the cost of capital obviously is higher. So until that EV demand comes back, these companies are sort of in this bear market. Now, I will say that everyone that I've spoken to in the lithium space believes that the EV slowdown is exaggerated. They do believe that this is going to come back to a deficit of supply in the market. It just depends how long.
And now let's address the bigger issue. If Tesla is actively cutting prices, what happens to profitability? Well, truth be told, cutting prices might not be the recipe for boosting margins, but Tesla's got a few aces up its sleeve. First up, its gigafactories are churning out batteries and cars at breakneck speed, and this massive scale and constant innovation is going to help bring down production costs, giving Tesla more wiggle room to play with. Right now, batteries are expensive, but Tesla has been investing heavily in battery technology to make them cheaper and more powerful. This not only improves its cars, but it's also a major cost factor, which allows the company to once again play with its price tag. Plus, Tesla is also constantly streamlining operations, thereby becoming more efficient with every bolt tightened. So, while its price cuts are a calculated risk, it's one that Tesla believes it can weather thanks to unique production processes. Likewise, Tesla is constantly streamlining its operations, getting rid of any unnecessary fluff and focusing on pure manufacturing efficiency, meaning less waste, lower costs, and more room for future price cuts if needed. And to be honest, Tesla's not exactly hurting for cash. Rather, the car maker has expected that it's going to be lowering prices, and it will bring in more customers with that, which in turn means more data and more experience, and ultimately even more efficient production down the line. It's like planting a seed. Tesla is investing now for future growth, and lower prices are the fertilizer for boosting that growth.
All right, let's take a look at Tesla, because Tesla once again slashing prices, this time in Germany. The EV maker cutting prices of its Model Y in the country after previously pulling back on the cost of its Model Y and Model 3 vehicles in China. That was announced last week. We brought that news to you. We're seeing some pressure on the stock here this morning, off about 2%. The reason why, and one of the issues that analysts have talked about time and time again here at Yahoo Finance, is the price cuts, what exactly that's going to do to margins, the pressure that could then put on margins. We've seen that over the last couple of quarters here for Tesla, and it looks like as these price wars play out on a global scale, that's something Tesla's going to continue to contend with.
I mean, as we see this kind of pullback in EV demand right now, what you're seeing is price cuts as a demand generation mechanism from the auto manufacturers right now, and none more so than Tesla, because their structure is vastly different. It's not a million dealerships that are around the world that are pumping all of these different vehicles that have been produced and delivered to some of those dealers on a regional basis through their own cost mechanisms that can have more of a one-on-one relation for each sale. For Tesla, it's online, and it's being able to go into certain malls to be able to place some of those orders, or at least find out more about what the vehicle can do. What was interesting is that even now we're getting more data year over year about where the used car sales of some of these vehicles.
Tesla is dropping prices, but the reasons are actually pretty crazy, and potential outcomes are multi-layered. In fact, they're more complex than a simple sale sign. The price slash isn't just about selling more Teslas, although that's a part of it. However, there is a bigger picture here. Imagine a world where EVs are everywhere, available to all and accessible to all. This is the ultimate goal, and Tesla's price cuts could be the push to get us there. By making EVs more affordable, Tesla is encouraging more people to ditch gas guzzlers, which means less pollution, a happier planet, and maybe fewer visits to the gas station. Also, other car makers will have to step up their EV game to compete, which could lead to even more innovation, better technology, and ultimately more choices for eco-conscientious car buyers. So you see, it's a win-win for everyone. No doubt sustainability is not cheap. However, by making EVs more accessible, Tesla is helping to usher in more sustainable ones for the future, 1 mile at a time. It's like a snowball effect: more EVs, less gas, lower emissions. Of course, there are skeptics. While some worry that Tesla is diluting its brand image, others question if the car maker can also sustain these cuts in the long run. But hey, that's the beauty of the market. Only time will tell how this all plays out, but one thing's for sure, and that's that Tesla price cuts are shaking things up. And that can only be good news for the environment, the auto industry, and maybe even your wallet. That's if you're on the lookout for a sleek new ride. Tesla's price cuts are a step forward for a more sustainable future, but it's not some fairy tale with guaranteed happily ever after endings. It's a constant experiment, and only time will tell if the gamble pays off. So what do you think? Is Tesla making the right decision by lowering car prices? Let us know down below, and don't forget to tell us what your valuation of Tesla is. And if you want to know more about what Tesla's been up to over the last few days, go ahead and click on this next video on your screen. See you there.